Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ross Kay. He's a home ownership consultant out of the wealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back, Jim.
Ross, with January under our belt, maybe it's a good time to talk about the spring real estate markets in Vancouver and Toronto. What are we likely to see in Vancouver and across BC?
Okay, so it is a good time to talk about the spring market, and it's a good time to talk about the spring market because what is going to happen in February, March, and April has already been decided. The market that we just came through from November, December, and then including January. I mean, we're talking February 5th today is the time of this interview. Those previous 3 months are going to dictate what is going to happen in the next 3 months. What I mean to say is that the real estate markets work on patterns and on cycles and on periods and on stages. We monitor all of those different parts of the housing market, and that's how we know what's going to happen in the market months in advance. So what that meant was on Friday, when the Real Estate Board of Greater Vancouver announced that their sales had increased, I think they said about 10% was what their press release said. What it meant to us was, no, it really didn't increase 10%. What it meant is that back in December, there was an extra 300 sales that were recorded. Those extra 300 sales from the month of December were going to have to be, meant that there were an extra 300 families that sold their home through a member of the Vancouver Real Estate Board, currently homeless. In other words, they hadn't gone out and purchased their next home. That meant that when January's numbers got released, we would expect to see those 300 extra sales show up in January sales numbers. What exactly happened on Friday was the Vancouver Real Estate Board claimed there were 300 extra sales that took place in January of 2018 that didn't take place in January of 2017. That's how precise a housing market functions, Jim. This is how precise markets operate. Now, you have to know how to record what's happening in the previous months in order to be able to extrapolate that into forecasts for the months coming forward. Because not only are the sales taken into account, also the selling price that will be announced months ahead is going to be dictated by what happened in the previous months. When we looked at the market intelligence from October, November, and December, we knew that January sales average selling price in Vancouver had to be somewhere around $1,040,000. That's where the number we expected that it would be arriving at. That's exactly what that number arrived at. It was just a little tiny bit over $1,040,000. This is not genius. This isn't that we're able to. We've got a crystal ball where we're guessing about what's going to happen in the market. These are strictly market-driven metrics. They are unavoidable. We know what's going to happen in the market months in advance. How far we can go in advance is the only question that we have. It's easy to forecast 3, 4, 6 months in advance. Once you start going beyond 6 months, that's a little bit more tricky. Certainly, it's more tricky when you're at the end of a trading cycle or the start of the next one. But again, as long as you're always watching the market, you're able to forecast. So we know that in Vancouver, as we walk into the spring, we know that the sales are compounding. So you will see existing owners of homes who have sold their homes increase in numbers. That adds to what we call the multiplicity of sales. The only thing that stops a housing market is when first-time buyers withdraw from the market, as we have said in your show dozens of times over the last couple of years. We know that a lot of the price drop that you saw in the Vancouver market in the spring of 2017 was caused not by housing prices changing, but because more first-time buyers were jumping into the market. Their share of sales increased. That drove the average selling price down. So in terms of measuring the market in Vancouver and across British Columbia, the spring market has already been recorded. It's already written down. It is unavoidable. The only problem you have out in British Columbia continues to be the benchmark price. And before I leave this topic, Jim, I want to discuss the benchmark price with your listeners here. Your listeners need to go to the Real Estate Board of Greater Vancouver's website and download their January 2015 housing report. It's available on the Real Estate Board of Greater Vancouver's website. And then I want you to download the report from last Friday for January of 2018, 3 years later. And I want them to go and look at the residential Greater Vancouver benchmark price. That is the one that includes all of the houses. It just makes it easier for everybody to see. Back in January the 2015, the benchmark price of all houses in Greater Vancouver was $641,000 and $641,000 and $600. That number back then, when we look at the Real Estate Board of Greater Vancouver's average selling price, which is the number that is tracked across every other real estate board in Canada, was $813,000. So there was a staggering spread between the benchmark price and the average selling price, because the benchmark methodology takes months and months and months to catch up. What happens when it catches up so quickly that it goes by it. And when your viewers look at the benchmark price that was released last Friday, they're going to see that benchmark price had increased rapidly over the last few years, and that benchmark price for all of Greater Vancouver had increased to over $1 million. That increase means that the average selling price, the benchmark price, has caught up to the average selling price. So when you started out this cycle, the benchmark methodology screwed up everybody so much that there was a negative of about $180,000 between benchmark and average selling price. All of that has been removed over the last 3 years, and it's caught up. That is why the benchmark price has increased percentage-wise so greatly over the last 3 years, when the average selling price didn't. So when we're talking to you about the Vancouver and the British Columbia market for the spring of 2018, your listeners have to remember the benchmark methodology that measures price never works. It's never correct. It's always wrong. It's always wrong because of the methodology that is involved in it. The average selling price is the only metric that the average consumer can look at to get an idea of what the housing market is doing, because it's measuring what buyers are paying, not a guesstimate of a benchmark methodology to come up with a mythical value of a standard home, which only happens in British Columbia. This variance does not happen in any other province in Canada except for British Columbia. So that's what you need to take into consideration when we're talking about the Vancouver market, Jim. The 300 excess sales that were reported by the Real Estate Board of Greater Vancouver on Friday, they were actually already recorded back in December. I also want to leave your listeners with one thought, the listeners out in British Columbia. If you're looking at the Vancouver housing market and you're looking at purchasing a property in Vancouver or selling a property, I highly encourage you to seek out a realtor from the Fraser Valley Real Estate Board. And I say it for this reason. Fraser Valley Real Estate Board members can sell in Vancouver. They're just as equal and adept at selling in the rest of Vancouver as they are in where the jurisdiction of their real estate board is. The two boards overlap. But what the difference is that realtors from the Fraser Valley Real Estate Board are brainwashed in a different way by their real estate board than the Real Estate Board of Greater Vancouver is. If you look at the stats pack between the two real estate boards, they are substantially different. And what that means is the sales reps at Fraser Valley Real Estate Board get into the business, grow their business, work with housing materials using the stats released by their real estate board. While in Greater Vancouver, they deal with stats that are released with their board. The superiority of the Fraser Valley Real Estate Board stats package means that the realtors themselves, even though still ignorant to how housing markets function, the realtors from Fraser Valley are actually better qualified to handle a real estate deal than the realtors from the Real Estate Board of Greater Vancouver. Now, I'm going to tell you, I would never use either one of them alone without some assistance. That said, I know a lot of your listeners will. So the one piece of advice I have for them going into this spring is deal with a realtor from the Fraser Valley Real Estate Board and not the Real Estate Board of Greater Vancouver. If you want to buy a house in Vancouver, go find a realtor that is their home real estate board is the Fraser Valley Real Estate Board. Because at least their stat package gives more metrics that allows those realtors to develop more understanding of a housing market. That's the one tip I'd like to leave as we talk about going into spring of 2018 for Vancouver.
We'll have more with Ross Kay right after the break.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Ross Kay. Ross, what does the Toronto market look like going into the spring?
Okay, so the Toronto market, Jim, is basically just the opposite. Now, when I'm talking about the Toronto market, I'm not talking about the Toronto market. I'm not talking about the Greater Toronto area. I'm not talking about the Greater Golden Horseshoe. I'm talking about the stats pack that will be dumped by the Toronto Real Estate Board tomorrow. So their stats pack is used by the mainstream media across Ontario to represent what's happening in the Toronto housing market. It is not, but that's what they use. What that means is that sometime tomorrow you're probably going to hear that there were about 400 fewer sales in January of 2018 than there were of January of 2017. Just the opposite of what Vancouver Real Estate Board reported. So it's 300 more in Vancouver, and it's probably going to be 400 less in, we're expecting 400 less in Toronto. That will be possibly a little bit more than that, depending on how the real estate board manipulates their sales at the end of the month. So this is what your Ontario listeners need to understand. The Real Estate Board of Toronto didn't release on Monday. They're going to release on Tuesday. That allows them to review the data from January 30th, 31st, 1st, and 2nd, and look at the sales totals. Their boards then have the ability to guesstimate whether it's more beneficial to push a few sales into February, so that when February's market stats get released, it makes February look better, or push a few sales that would have been in February and record those as January sales to make January sales look better. So the manipulation of 150 sales plus or minus is an ongoing process at every real estate board that releases information to the stats pack to the newspapers. These manipulation of stats are there. The real estate board can do this because they use the following term in their footnotes. They release the term, the following sales were reported through the MLS system during January. They're not telling you that these houses sold under January and that they're reporting those sales. They're saying that the sales were reported. It's two totally different things. It's why they can't be sued by the Advertising Standards Council of Canada for lying to the public. The real estate boards have the disclosures in the footnotes that anyone can read that specifically state they're really not counting the same thing from month to month. They can shift sales from one month to another. They can backdate their information. They can change their information. So when I'm looking at my stats for Toronto, when I see that there are, right now, we're missing about 408 sales. There's about 408 sales in December that we're missing. So I expect those sales that will show up in as missing sales again in December. The real estate board can mess with that a little bit. That's how precise yesterday's sales will record tomorrow's sales. It is an exact mathematical calculation. The margin of error is so small that we can tell everybody, look, if we're wrong, we won't charge anything. That's why we're able to make these claims, because the forecasting is not really forecasting. When you're telling someone what's going to happen in the spring of 2018, that's already been decided. The Toronto real estate market has been in a contraction using our metrics since March of last year. So that market has been contracting. Their housing prices, the overall housing prices in the city of Toronto, they're still going to be contracting for the next couple of months. Now, that contraction is going to hit a rough period in March and April because of the way that the cycle rolled over and the way that which categories of buyers were purchasing last March and April versus which categories of buyers will be purchasing this March and April. Your listeners need to understand the reason why housing prices go up and down month to month and they don't stay level is because, although they're always moving in one direction, is because the sales mix changes from month to month. And if you're not monitoring the sales mix, you don't know what I'm talking about today. If you know how to measure the sales mix, when I tell you there's 400 sales missing, you know exactly what I'm talking about. If you are measuring the sales mix and you know where those buyers are missing from the sales mix, you know how that's going to impact tomorrow's price. And that's simply how it works. Housing prices cannot jump these 30% that people were led to believe in Toronto last spring and in Vancouver back in the spring of 2016. That is impossible. That's only possible if the sales previously recorded allow enough equity to be passed through to get enough to make the selling price higher. It has got nothing to do with the price of houses, which is why the housing market in Vancouver never hit a 30% gain, and it's why the housing market in Toronto never hit a 30% gain. The truth of the matter is, even though the newspapers didn't report it, the Toronto real estate market hit a higher annual increase percentage-wise than Vancouver ever hit. But you didn't read that in the newspapers. You read that Vancouver's was the craziest market on record, and that Toronto's never got to that point. Then you heard the crazy comments about how foreign buyer tax caused the housing market in Vancouver to crash. When, on your show, we told everybody it was months in advance it had already been contracting. The same thing in Toronto. They claimed that it was the Ontario Liberals who brought in policies that made the market reverse course. No. If you were listening to us, you heard that the market was already changing before those rules were applied. The governments just are making decisions within 1 or 2 months of the markets rolling over. And then they're either getting credit for that or they're taking the blame for that. That's the risk that politicians have entering a housing market. The spring of the housing market in Toronto is going to stay right on the pace that it's on. Sales are declining. There is a surplus of negative sales in the system. That means that there is a potential for a small rebound because there have been so many people that have moved out, Jim. Renting. This is another thing that your listeners have to understand about how the trading cycle impacts the housing market and how it really impacts all of the decisions that you should be making. At the end of the trading cycle, it's when the most number of homeowners sell their homes and decide to rent. At the end of the trading cycle, people are taking their profits from their house, putting it into the bank, paying off debt, doing a business decision, and they're deciding that they're going to rent. What that means is that the quality of renter who is coming into the market now is a far better quality renter than that was available 2 and 3 years ago. Because you're getting a renter who has owned their own home, who has decided to get out of the ownership market and into the rental market, and they will treat your rental unit just as if it's their own home. Something breaks, they're qualified to fix it. Something needs to be painted, they'll do a good paint job. The house that they will be looking for will be a better quality home, a house that's been well taken care of, a house with neutral decor, hardwood floors, updating. They will pay for the privilege of renting that house, which is why house price rentals, the rental costs increase at the end of a trading cycle. It's not that the rents are going up per se. It's that what is being rented is a better quality home. That information isn't ever given to the public. All you hear is the average rents have gone up. And it's exactly the same as the housing market. So what a savvy real estate investor knows who's going to rent out their properties is they purchase their properties early in the cycle and then they begin renting it at the end of the cycle. Because the property that they have purchased, they would have purchased maybe a pre-sale, a home that is going to be built 1 or 2 years later when the real estate cycle has moved forward substantially. And at that time, their opportunity to get a better quality tenant increases. They get to pick and choose who they want to look at. Because when we're looking at the Greater Toronto Area, we know that there have been over 20,000 homeowners sell their home and not buy another one as of right now. That means there's 20,000 former owners looking to rent a quality home. What a great opportunity for a landlord, Jim.
We'll have more with Ross Kay right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, jobs and home buying seem to be going hand in hand in the U.S. One of our listeners wondered if the job numbers south of the border will impact the Canadian housing market.
Smart question, easy answer. Yes. Yeah. As jobs, so we're not economists. As I've said on your show here 1,000 times, we're not stock market analysts. We're not into advising some people what to do with the stock market. But in terms of how a housing market works, knowing these sort of things is very important. We know that as unemployment numbers decrease, so the number of people becoming employed increases. There is an increasing pressure on the economy to raise interest rates. That's simply how it goes. What you're looking at in the United States right now is they were already at a pretty good employment rate when Trump came to power, and in the last year, even more jobs have been coming out, and they're claiming that America is now virtually fully employed. What that means is that the Federal Reserve in the United States has the ability to raise, almost has a need to raise interest rates, because once the job numbers reach a certain point, there is pressure for wages to rise, which means inflation increases, which means the federal government acts to keep inflation in check by raising interest rates. This is how the American economy actually impacts the Canadian housing market and the Canadian homeowner. As the interest rates rise in the United States, that means that the bond yields are going to also offer attractive opportunities for people. As those bond yields increase, mortgage rates are forced to increase in the United States and Canada alike. So, better job numbers in the United States of America means higher interest rates in Canada. I can't comment, Jim, on what it means to the overall economy of Canada. I can't comment what it means to the stock market. I can't comment about anything. All I know is we track job numbers specifically so we have an understanding of what's happening to wage pressures in the United States, so that we have some understanding of what's going to happen to inflation and correspondingly to actions by the federal government in the states on interest rates. So this job market in the United States, the supposed roaring economy in the United States, higher wages in the United States, these bonuses, the lower income tax being charged to taxpayers in the United States. All of these things create inflation, an inflationary environment, which means interest rates are probably going to rise. That means Canadian interest rates are going to have to rise. It doesn't matter what the Bank of Canada governor says. It doesn't matter what the federal Liberals say. It doesn't matter what the BC Liberals or the BC NDP say. What matters is what the Americans say. And if the Americans start to raise interest rates, as they have, Canadian mortgage rates will follow suit. Mortgages are tied to bonds. That being said, that starts to add a little bit of complication in the discussion, and there's a lot of really misreads of the bond market in the Canadian mortgage market. So I'm not going to get into that discussion. Just keep it simple. If jobs increase, the number of unemployed drops in the United States, it only makes common sense that wages will go up. If wages go up, it means that there'll be inflation. If there's inflation, it means the government of the United States will act to keep inflation in check. They have targets that they'll want to maintain. That means interest rates will go up. If interest rates go up, Canadian mortgage rates go up. If Canadian mortgage rates continue to go up, which they're going to, it means the housing market will slow. It means that you will no longer, the average Canadian home buyer will no longer be able to spend as much money as they are now on principal, on home equity. They are going to have to spend more of their money on the cost of interest. So the balance of a home ownership market, which is where equity is on one side of the scale and debt is on the other side of the scale, starts to get tilted more towards the debt side. And as the debt side goes up, as the debt side gets bigger and bigger, like heavier and heavier, the scale lifts on the equity side and equity is relieved. There cannot be as much. It always happens in a balance. That is simply how it works. So, the simple answer is, if job numbers increase in the United States, if employment gets better and better in the United States with higher wage growth, it means the Canadian homeowner will pay more interest to the bank to own their home.
Ross, thank you so much for chatting with us.
Hey, thanks a lot, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. You're listening to HoweStreet.com radio. Questions for our guests or show can be sent to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.